A $500,000 house in 2026 requires a $150,000 salary to afford comfortably, not to qualify for, to actually afford. And I'm about to show you exactly why. You're lying in bed at 1 a.m. doom scrolling Zillow because apparently that's what adults do for entertainment now. Every house that doesn't require a hazmat suit to enter is listed at $500,000. The photos show popcorn ceilings, a bathroom straight out of 1987, and a backyard you could mow with scissors. But the description calls it charming and move-in ready. You pull up your calculator app and start punching numbers. Then you punch them again because surely you made an error. You didn't. It's not your imagination. The housing market has gone completely off the rails, and today I'm going to do something that makes real estate agents very uncomfortable. I'm going to show you exactly who can actually afford a $500,000 house in 2026. Not who can get approved for one, but who can buy one without their entire financial life becoming a disaster movie. Because those are two very different things. By the end of this video, you're going to know the exact income required to comfortably afford a $500,000 home. You'll understand why the numbers your mortgage broker gives you are basically financial fantasy, and you'll have a framework to figure out what you can actually afford, not what some algorithm says you qualify for. First, we need to establish something. In 2026, $500,000 doesn't buy you a mansion. It doesn't even buy you something impressive. In markets like Phoenix, Raleigh, Nashville, or anywhere within an hour of a major city, $500,000 gets you approximately 1,400 square feet, maybe a two-car garage if you're lucky, and a lot that your neighbor can see directly into. This is the new normal. This is what regular families are expected to somehow purchase with regular incomes. The median household income in America hovers around $84,000. We're asking typical families to buy homes that cost roughly 6 times what they earn annually. If your gut reaction to that ratio is, that seems insane, congratulations. Your instincts are working, but the housing industry keeps insisting this is fine. Mortgage lenders approve these loans every day. Your coworker just bought a place. Some guy on social media is telling you real estate is the only path to wealth. Let's start where most home ownership dreams quietly die. The down payment. The traditional advice says put 20% down. On a $500,000 house, that's $100,000 in cash. Not equity, not assets. Cash you hand over at closing. The average American savings account contains roughly $8,000. You're not slightly behind on this goal. You're $92,000 short. But maybe you're disciplined. Maybe you can save aggressively. Let's run those numbers. If you earn $84,000 and manage to save 10% of your gross income, ambitious for most households, you're setting aside $8,400 per year. At that pace, you'll have your down payment in about 12 years. But housing prices aren't going to sit still and wait for you. They've risen faster than wages for decades, and there's no indication that trend is reversing. So most people skip the 20% down. They put down 5% or 10% instead, which seems like a reasonable compromise. But it's not free. This is where the real financial trap activates. When you put down less than 20%, you unlock a wonderful little expense called PMI, private mortgage insurance. PMI exists to protect the lender if you default, not you, the bank, and you get to pay for it every single month, typically somewhere between $200 and $400, depending on your loan size and credit score. Think about that. You're being charged a monthly fee because you weren't wealthy enough to have $100,000 lying around. It's essentially a penalty for not being rich, and it can add up to thousands of dollars per year. Before you've even made your first real mortgage payment, you're already in a financially punitive position. But the down payment is just the appetizer. The main course is what happens every single month for the next 30 years. Let's say you scrape together $50,000 for a 10% down payment. That leaves you with a $450,000 loan. At current interest rates, somewhere in the 6.5% to 7% range, depending on your credit, your monthly principal and interest payment lands around $2,800 to $2,900. But that number is incomplete. That payment doesn't include any of the other costs required to actually own and occupy a house. Property taxes vary wildly by location, but a conservative estimate is $400 to $600 per month. Homeowners insurance has exploded in recent years thanks to climate related claims, running another $250 to $400 monthly depending on where you live. Then there's maintenance, the financial reality that houses break constantly and expensively. The standard rule is budgeting 1% of your home's value annually for repairs. On a $500,000 property, that's $5,000 per year or roughly $417 per month. And don't forget that PMI we talked about. Add another $300. Your actual monthly housing cost looks something like this. Mortgage, $2,850. Property taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. Total approximately $4,367 per month. That's $52,000 per year just to keep a roof over your head. And this assumes nothing goes catastrophically wrong. No major repairs, no special assessments, no surprise increases in your escrow. Financial advisors generally recommend spending no more than 28% of your gross monthly income on housing. Banks will approve you up to 43% for your total debt to income ratio, but that's the ceiling, not the recommendation. Let's work backwards from our $4,367 monthly housing cost. If that represents 28% of your income, the financially healthy threshold, you need to earn roughly $187,000 per year. If we use the bank's more aggressive 43% threshold, you still need household income around $150,000 annually. But only about 15% of American households earn $150,000 or more. Approximately 85% of households cannot comfortably afford a $500,000 home under any reasonable financial framework. This isn't pessimism, it's arithmetic. If you're finding this breakdown useful, hit that subscribe button. I release videos like this every week. Real numbers, no fluff, no trying to sell you a course. Just the math they don't want you to see. Let's make this concrete with a real-world example. Meet the Mitchells, a fictional but realistic couple. Both work professional jobs. Combined household income, $165,000 per year. That puts them well above median, solidly upper middle class. On paper, they should be comfortable. Watch what happens when they buy that $500,000 house. Their gross income sounds impressive until taxes enter the picture. After federal, state FICA, and a modest retirement contribution, they're taking home approximately $9,800 per month. Subtract that $4,367 housing cost. They're left with $5,433 for everything else. 2 car payments. Suburban life requires 2 vehicles. $850. Auto insurance, $280. Fuel costs, $320. Student loans from the degrees that got them these jobs, $650. Health insurance premiums their employers don't fully cover, $380. Groceries for a family trying to eat reasonably well, $900. Utilities for the bigger house, $480. That's $3,860 in non-negotiable monthly expenses. The Mitchells have $1,573 remaining for everything else. Clothing, haircuts, the kids' activities, birthday presents, car repairs, medical copays, entertainment, emergencies, retirement savings beyond their minimal 401k contributions. This family earning $165,000, more than double the median household income, is spending 45% of their take home pay on housing alone. They're not making irresponsible choices. They're not living extravagantly. They're just existing in a house that the market considers normal. Numbers on a spreadsheet don't capture the daily reality of being house poor. It feels like hesitating at the grocery store because you're not sure if you can afford both vegetables and meat this week. It feels like telling your kid you'll think about it when they ask for a $12 book at the school fair. It feels like driving on tires that probably should have been replaced 2 months ago because you can't spare the $600. It feels like your stomach dropping when your phone buzzes with an email from the HOA. It feels like genuine panic when the check engine light comes on. It feels like lying awake calculating whether you can technically survive until your next paycheck. We've normalized this. We call it the reality of homeownership, as if financial anxiety is just part of the American dream. We've rebranded struggling as adulting, but struggling isn't adulting. Struggling is struggling. And a house that causes constant financial stress isn't an asset. It's a liability wearing an asset costume. If this math is so obviously broken, why do people keep buying houses they can't afford? Because every person involved in the transaction profits when you buy, except you. The bank earns interest for 30 years. The real estate agent earns commission based on sale price. The mortgage broker gets paid when the loan closes. The title company, the inspector, the appraiser, everyone in the chain makes money when you sign. Nobody has a financial incentive to tell you this is a bad idea. The system is designed to get you into the house, not to ensure you can thrive once you're there. And once you've signed those papers, you're locked in. You can't easily exit without destroying your credit and losing your down payment. So people stay. They stay in houses they can't afford, working jobs they hate because they can't risk income disruption, watching their financial flexibility evaporate year after year. This isn't home ownership. It's indentured servitude with granite countertops. What should you actually do? First, stop using bank approval as your benchmark. The bank's risk tolerance and your quality of life are completely different calculations. They'll approve loans they statistically expect to get repaid. They don't care if you're miserable for 30 years in the process. Second, calculate your real number. What can you spend on housing while still saving for retirement, maintaining an emergency fund, and occasionally enjoying your life? For most people, that number means either a significantly cheaper house or more patience before buying. Third, reject the cultural pressure. Yes, your parents bought a house at your age, but their house cost 3 times their annual income, not 6 times. The comparison isn't valid. Different economy, different math, different reality. Fourth, consider whether home ownership right now actually makes sense for your specific situation. Sometimes the smartest financial decision is continuing to rent, investing the difference, and waiting for either your income to rise or the market to correct. There's no trophy for buying a house that makes you miserable. There's no award for being house poor. The stress of barely making payments every month will erase any pride you felt at closing. A $500,000 house costs approximately $4,367 per month when you factor in mortgage, taxes, insurance, maintenance, and PMI. To afford that comfortably, spending no more than 28% of your income on housing, you need to earn roughly $187,000 annually. Even using the bank's more aggressive 43% threshold, you still need about $150,000. Only about 15% of American households hit that income level. For the vast majority of people, $500,000 home isn't affordable under any reasonable definition. If you're looking at houses in this price range and your household income is below $140,000, you need to stop and reconsider. The numbers aren't going to magically work because you want them to. You're not failing because you can't afford a $500,000 house. The system is failing you. Home prices have dramatically outpaced wages for decades. What previous generations achieved isn't a fair benchmark for today's buyers. Making a decision based on actual math rather than social pressure or emotional desire isn't giving up. It's the smartest financial move you can make. The housing market will keep pretending these prices make sense. Banks will keep approving questionable loans. Real estate agents will keep encouraging you to stretch. But you don't have to participate in collective financial delusion just because everyone else is. Sometimes the winning move is recognizing when the game is rigged and choosing not to play. If this video changed how you think about housing affordability, subscribe and turn on notifications. Every week I break down the financial realities nobody else wants to talk about. Student loans, retirement, investing, all of it. Drop a comment below. Can anyone actually afford these prices, or has the market completely lost touch with reality? I'll see you in the next one.